Good afternoon, everyone. My name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main presentation in just a moment. I want to give everybody a chance to log on before we get started. For those of you who are on the phone, you are in mute-only mode, which means that you can hear me, but I cannot hear you. If you have questions in the formal part of the presentation, please type them into the box on the lower right-hand side of your screen, and we'll get to them after the formal part of the presentation. Try to wrap this up in an hour. Obviously, if we get a lot of questions, we might run over, but the webinar is being recorded. So if you miss that or have to get off, not a problem. You will have a link to the recording. If there are questions that you want to tell me that you do not want to be out, just send me an email and we'll take them offline. So I'm going to go away here for about a minute, and then we'll start very shortly. Thank you. Good afternoon, everyone. For those of you who have just joined, my name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation, ESOPs, a tax-efficient exit strategy, in about another 30 seconds or so. For those of you who have just joined, you are in mute-only mode, which means that you can hear me, but I can't hear you. So please type the questions that you might have into the presentation box, into the question box of the lower right-hand side of your screen, and we'll get to them after the formal presentation is over. So with that, I want to start the presentation. And Nick, why don't you introduce yourself?
Fantastic, and thank you, Bruce, and thank you for everyone for participating in the webinar today. I'd be remiss if I didn't say that through these challenging times, obviously we're thinking about everyone and their families. Hope everyone is well, safe, and healthy, and appreciate you giving time away from your business and from your family today to participate in the webinar where we're going to talk about ESOPs, a tax-efficient exit strategy. Speaking is Nick Francia. I am a Senior Vice President, Wealth Management at UBS. I'm one of two partners of the Capital ESOP Group. Myself and my partner, Keith Apton, run the Capital ESOP Group on behalf of the firm nationally, managing a team of 10 professionals in the Washington, D.C. and New York areas. Our entire practice is focused on educating privately held business owners on different ways to potentially monetize a privately held business, and then through cash flow modeling and forensic analysis, helping them understand what the best exit strategy would look like for them, for the company, for their families, and ultimately for the employees as well. To start today's conversation, what I'd like to do is I'd like to just give a broad understanding of business succession planning, as well as what different options business owners have as it relates to different types of liquidity. As you can see on the first slide, there's a tremendous amount of wealth that is about to transition over the next 10 to 15 years. And through that transition, privately held business owners are going to be exploring different ways to potentially sell a business. And we've had significant change in the tax law in the last 10 years that has increased capital gains taxes to the privately held business owner. So when selling a business, at the federal level, you can pay anywhere from 15 to 23.8%. That's not including state tax, which can range anywhere from 0% in a state like Florida to 13.3% in a state like California. So what we'd estimate is average long-term capital gains tax is probably around the 30% range. So when selling a $10 million business, that means that you'd sell for $10 million, you'd have about a $3 million capital gain. Net to the business owner would be around $7 million in that example. If we go to the next slide, we can see the different exit strategies that business owners have. And each one of them come with their own pros and cons. And there's not one exit strategy that works best for any business owner. But we have both internal and external transactions. And if we go one more slide, we'll see both those internal and external transactions. On the internal side, you have a management buyout, which is essentially when the managers of a corporation come together and purchase the stock from the selling shareholders. A lot of times management buyouts are difficult because of the sources of capital. Where's the management team going to actually get the cash to purchase the stock? You have dividend recaps, which is not actually the sale of equity, but rather a dividend out to the business owner, which is a way for them to get liquidity, but it's not very tax efficient. And it proves to be difficult, again, from a capitalization perspective. Also on the internal side is an intergenerational transfer, which is when the business owner wants to transfer stock to future generations, whether that be to their kids or their grandkids. The research that we've done at UBS is when it comes to intergenerational transfers, the millennial generation wants the wealth that was created from the family business, but they don't necessarily want to participate in the family business. So a lot of the millennial generation isn't actually going into the family business, which again is taking a turn for these business owners that have maybe counted on a son or a daughter to take over the business, and now they have to pivot and figure out what's the best exit strategy outside of that. You also, on the internal side, have an employee stock ownership plan, an ESOP, which is what we're going to focus the predominant amount of time today. And an ESOP, in its simplest form, is a way for a privately held business owner to sell a portion or all of their stock and permanently avoid capital gains taxes in the process. On the external side, you have three very familiar types of strategies. You have a sale to a strategic buyer, which is essentially a competitor coming in, somebody that sees a strategic acquisition that they can make. They're willing to pay a premium. That's where the term strategic premium comes into play. They purchase the company, business owner pays their capital gains tax, and it's relatively simple. You also have sale outright to private equity. There's a tremendous amount of cash on the sidelines of private equity, both pre-COVID-19 and post-COVID-19. So private equity for the last 8 years has been extremely active in buying companies, whether it be through a roll-up strategy or just going out and making strategic acquisitions. And then finally, you have an initial public offering, an IPO, which is a very, very small subset of the privately held business owners in the country. But essentially, if you're large enough, you can file an S1, you do the roadshow, and you can go public. On the next slide, we can see how you can evaluate these different exit strategies. And essentially what we've done is we've taken each one and we've said, looking at from the most liquid or greatest pre-tax value to the most control, where do all of these stack in those rankings? And the three things that I think that we hear the most when talking to business owners and helping business owners evaluate what the best option is, the three things we hear the most are, what's the value of my company? Meaning, in any type of exit strategy, how much value am I going to be able to pull out of this company? Number two, how much cash can I expect to receive at closing? And if there's any sort of seller note or seller financing or an earnout, how quickly can I expect to receive that payout? And the third thing is, who's going to control my company post-transaction? Is it me? Is it my board of directors? Is it an outsider? Are they going to take the name off the door? What are they going to do to my employees? So those three things, value, cash at close, and control, are predominantly the three variables that we're focused on when having conversations with business owners and trying to understand what they're trying to get out of a sale. So going on to the next slide. This is where we'll really start to focus on ESOPs. And the first thing that I tell people to do when I'm doing public speaking is forget the acronym, because the acronym itself is confusing. A lot of people believe it stands for Employee Stock Option Plan. Some people know that it stands for Employee Stock Ownership Plan. It really just depends on the context in which you're using it. In today's context, we're talking about an Employee Stock Ownership Plan. And as I said earlier, an Employee Stock Ownership Plan is a way for a privately held business owner to sell a portion or all of their stock and permanently avoid paying capital gains tax in the process. But in its simplest form, an ESOP is a tax-exempt trust. So the analogy that I would use would be equivalent to estate planning. If anyone's done estate planning on the phone, you hire a lawyer to draft trusts, to create trusts for certain beneficiaries and for certain strategic estate planning objectives. Well, an ESOP is very similar in that lawyers are creating the ESOP. They're creating a trust. And that trust is ultimately the purchaser of stock. That trust is what buys the stock from the privately held business owner. Now, an ESOP is also a qualified retirement plan. Very similar to a 401k and profit sharing plan. The main difference is that an ESOP has the ability to borrow money in order to purchase the stock from the selling shareholder. And an ESOP is also concentrated in the stock of the sponsoring company. So in a 401k, you may have a bunch of different mutual funds or exchange traded funds that participants can invest in that keep them diversified. In an ESOP transaction or in an ESOP plan, the assets in the ESOP plan are very concentrated to the sponsoring company's stock. So the way that I would break it out, and when I'm talking about why consider an ESOP or what an ESOP is, the way that I would break it out is I'd say it's a flexible, tax-efficient exit strategy. And the flexibility of the ESOP comes from the fact that you're creating the buyer. So unlike private equity, unlike a strategic, where a buyer is coming in and they're purchasing the stock from the business owner, but they also have their own motives and objectives, and they're really trying to obviously make a deal that's good for them, where they can own a controlling interest in the business post-transaction. An ESOP doesn't necessarily have to buy a controlling interest. Because you're creating the buyer, you can sell 30% of the stock to the ESOP. You can sell 40, you can sell 49. Those are all minority stock sales. And what that does is if you're looking for a transaction that allows you to diversify your net worth, take some chips off the table, insulate your lifestyle, you can do a partial transaction, take the capital out of the business, capital gains tax-free, and continue to run the company as a majority shareholder. And in 3 years, in 5 years, in 10 years, however long it takes, you can then decide what to do with the other shares of stock that you still hold. And if that means that you want to sell those shares of stock to the ESOP and do a second stage transaction, you can do so. It's a built-in buyer. But if you also wanted to explore selling outright to a strategic buyer, selling outright to private equity at that point in time, with the remainder of the stock that you still held, you could do that as well. So it provides you a tremendous amount of flexibility. You can also sell 100% of the stock to the ESOP. And by doing so, you're obviously accelerating your exit because you're doing 100% sale today rather than doing a multi-stage transaction over a couple different years. So that's the flexibility. The tax efficiency comes in two forms. The first is at the individual level, which I highlighted briefly, which through section 1042 of the Internal Revenue Code, which was put in place in 1986, if you sell stock to the ESOP and you qualify under certain requirements, you can defer or with the proper planning permanently avoid the capital gains tax in connection with the sale. So when you're running a comparative analysis and you're talking about your different options, when the first couple options is selling to a strategic, selling to private equity, which is going to ultimately trigger a capital gains tax to you, ballpark numbers 30%, or you can sell to an ESOP and not have to pay that 30% in capital gains tax. It's a tremendous incentive to explore the ESOP on an after-tax proceed. And what it also allows you to do is compare things apples to apples, because sometimes an ESOP's not the right fit. And what makes the most sense is selling to private equity or is selling to a strategic. But what you can do is you can use the ESOP as a negotiation tool to ultimately drive up value in the open market for you, because you want to compare the strategic offer to the tax-free offer of the ESOP and really make that strategic buyer sharpen their pencil and offer you more money to try to equal what the ESOP is going to be able to pay you for your stock net of taxes. So that's the first tax benefit. The second, at the corporate level. So an ESOP is a tax-exempt trust. And because an ESOP is a tax-exempt trust, there's significant tax benefits at the corporate level. As most of you probably know, if you're business owners on the line, about 70% of the transactions or 70% of the companies that we work with are S corporations, also known as flow-through entities. So the way that that works from a tax perspective is every year, the profitability of the company or the profits of the company flow through to the shareholder. So if it's an individual that owns an S corporation, the profits every year flow through to the individual. The individual pays taxes at their own individual tax rate. Well, if the company is 100% owned by the ESOP and the company's taxed as an S corporation, all the profits every year now would flow through to the ESOP. The ESOP is a tax-exempt trust, so the ESOP doesn't pay taxes. So what that means is if you can operate as a 100% ESOP-owned S corporation, you are now federally and most state tax-free. So you don't pay any more taxes at the corporate level. So from a free cash flow perspective, it's extremely valuable when you talk about paying down debt, when you talk about reinvesting back into the company, when you talk about buying real estate or bonusing out key management. You have a lot more free cash flow to do so and to really accelerate the repayment of debt in connection with the transaction. So that's the tax benefits. The last thing I said is that it's an exit strategy, and it truly is an exit strategy. It's not the sale of a business. And the reason I say that is the sale of a business, in my eyes, is a clean break. It's 100% cash offer. You pay your capital gains tax, and you don't have to think about the business anymore. You don't have any business risk, and you've really put a transition in place. A lot of times, that deal works for a lot of people. 100% cash, pay your capital gains tax, no more stress, you're out of the business. With an ESOP, because it's a leveraged buyout, and we'll go through how the cash flow and how the flow of funds of an ESOP works here in a minute, but because it's a leveraged buyout, regardless of you doing a partial or a 100% transaction, you have some level of business risk post-transaction. So if you sell a portion of the business to the ESOP, again, you're able to diversify your net worth, you're able to take some chips off the table, and you're able to insulate your lifestyle. But you still own a majority stock, or you're still a majority stockholder in the business, so you still have business risk. Well, in a 100% transaction, you will not get 100% cash at close. So maybe you get 40% cash at close or 35% cash at close. And the remainder of the compensation that you're going to receive for the sale of equity to the ESOP is going to be in the form of a seller note, essentially an IOU from the company to the seller that's going to be paid out over a period of time. And so because of that, again, it's not the sale of a business, it's a transition. It means that you have to really believe in the solvency of the company moving forward. Because if you don't believe in the solvency and you think that Amazon's going to come around and ultimately drive the company out of business, an ESOP absolutely will not be the right fit. If you told me that you don't believe in the company or the management team long term, you should never consider an ESOP. You should go to the market, look at strategic offers, look at private equity offers. We would try to get you the highest possible value we could and get you out of the business. And so it's really important when you're considering an ESOP and comparing it to other strategies that you have a business owner that has that fire in the belly, that's willing to work with management, that's willing to stay on and really see the cash flow of the company continue to succeed. So let's go 2 slides ahead, Bruce. I covered the alignment of interests. Let's go to ESOP by the numbers, and then we'll go over the flow of funds. ESOP by the numbers, this is really interesting because a lot of people don't recognize how prominent ESOPs are in the US. And what I would say is ESOPs have varied in popularity over the last decade. With the new tax laws, we've seen a tremendous increase in business owners that have explored ESOPs, especially not just the tax increase, but especially the amount of business owners that are looking to transition and are looking to transition and keep the legacy and keep the culture intact. So we're having more conversations today than we probably ever have as it relates to implementing new ESOPs, but you can see that they're not uncommon. It's about 1 in every 9 businesses in the US, and some of the larger companies that you all know of are ESOPs. Publix, Wawa, Harpoon Brewery. You have a diverse group of sectors and industries that have really adopted ESOPs as an exit strategy. If we go to the next slide, we can talk quickly about what makes a good ESOP candidate. And this is important because not every company should consider an ESOP, or not every company is going to be the right fit, or every business owner, or every employee base. But when it makes sense and when it is the right fit, you can see how powerful the tax efficiency is. But what typically makes a good candidate, we start with obviously profitability. Company needs to be profitable, has to have strong cash flows. And the reason being is because an ESOP is a leveraged buyout. In order for this transaction to take place and for it to be successful, there's most likely going to be a commercial lender that is lending money to the company in order to consummate the stock sale from the selling shareholder. So you have to be able to support that level of debt. And through the cash flow and the profitability, you can do so. You also have to have a company that has a strong management team. This is unlike a private equity or strategic deal where a private equity or a strategic buyer would bring in their own management team and have them run the company. That's not the way it works with an ESOP. An ESOP is an internal transaction. So the same individuals that are there pre-transaction are going to be there post-transaction. So what that means is if you don't have a strong management team that can take over the business when the owner starts to transition out, you really need to start that process of hiring people prior to going into this transaction, or you have to have a business owner that is committed to seeing the training of the management team through, because that's the only way that the company will remain solvent long term. The other thing that I would say that's extremely important when considering an ESOP is making sure that the company has the ability to service the debt. So if you already have a lot of debt on the balance sheet, if there's already a lot of non-productive debt on the balance sheet, it's probably not going to make sense to explore an ESOP, because the extra added leverage in connection with the transaction, as well as the decreased value that you'd get as a business owner because the debt on the balance sheet, probably is going to make the structure unattractive. So we usually advise business owners to pay down the non-productive debt first, and then explore an ESOP, and then see what a transaction may look like for them. So let's go through the common shortcomings of different options on the next slide. Four different types of transactions that we look at in this scenario are sale to a strategic buyer, leveraged recap, minority ESOP, and 100% ESOP. And each strategy has its own pros and cons. And there really isn't one strategy that is going to check all the boxes for the business owner. What we like to say is, if you have 8 things or 7 things that are extremely important to you in a transaction that you want to make sure that you can accomplish through a sale, you may not be able to check every box, but see how many of those boxes you can check. And there isn't a perfect exit, but when you're looking at the different strategies, there should be one that stands out that accomplishes more of your higher priority goals than others. Sale to a strategic a lot of times is challenged because there is a very lengthy process and negotiation that takes place with the strategic buyer, as well as the uncertainty of the closing. A lot of times we have clients that feel that they already know that there's a strategic buyer out there, maybe a competitor that they've talked with in the past, that they think they can come to an agreement with. But when they really start to talk about numbers and they start to talk about the synergies in the business, they just seem to diverge, and it ends up not working out for either the buyer or the seller. Also, confidentiality is extremely important to business owners, and they don't necessarily like exposing their books and all of their information to possible competitors, because in the event that a transaction does not take place, they've now divulged all of their private information to a potential competitor. In a 100% ESOP buyout, there is certainly a more complex structure than just selling outright to a private equity or to a strategic buyer. There's definitely a use of leverage, as we'll walk through the flow of funds. You need to take on some level of debt at the corporate level in order to have the ESOP purchase that stock from the business owner. So there's certainly some downsides there. And then the length in which it takes for you to receive all your money. It's not a quick exit. You won't receive 100% cash at close. So it may take anywhere from 5 to 7 years for you to receive 100% of the proceeds in the sale of the business. And then with a minority ESOP, the downside really is going to be that you'll still have to take on business risk post-transaction. So if you do a minority stock sale to an ESOP and you sell 40%, let's say, the biggest downside or the biggest risk to you as the business owner is that you still hold 60% of the equity. Now, that could also be the largest upside, because if the company continues to grow, you get 60% of the growth of the company. But it's also a lot of downside risk in that you've only locked in today's value for 40%, and now you still have that business risk in the other 60. So let's go through what the flow of funds actually looks like in connection with the ESOP. So if we go to the next slide, we'll talk about how they work and how the company can actually take a loan to then help the ESOP make the purchase of stock. So step 1, company creates the ESOP. In order for the company to create the ESOP, again, the company and the business owner has to be the right fit. It has to make sense for all parties. But once the company creates the ESOP, step 2 is going to be for the company to borrow money from a commercial lender. And if we were to tie numbers into this, let's just say we're talking about a company worth $50 million. $50 million company has the ability to take on debt, whether that's $5 million of debt or $15 million of debt. A $50 million company has the ability to take on some level of debt. Let's just say in this example, it can take on $25 million of debt, or 50% of the enterprise value. So the commercial lender in this example would lend $25 million to the company. That's step 2. Step 3 is the company then lends that $25 million to the ESOP, creating what's called the inside loan. So now that the ESOP has $25 million of cash and the ESOP is the purchaser of stock, the ESOP has the ability to now make an offer to the exiting shareholders. So in step 4, the ESOP is now going to use that $25 million to purchase the stock from the selling shareholder. So if we're talking about a partial transaction, let's say we're talking about a 49% stock sale, round numbers, selling shareholder would sell 49% of his or her stock to the ESOP in exchange for $25 million of cash. That $25 million of cash, if it's protected under Section 1042 of the Internal Revenue Code, is going to end up being tax deferred or with the proper planning tax-free, and that's slide 5. So now you have a selling shareholder one day after the transaction is holding on to $25 million of cash and still owns 51% of the equity value of the company. So they still now have 51% of the upside, they have 51% of the downside. There's obviously $25 million of debt on the balance sheet of the company that needs to be serviced through the cash flow, but the business owner has accomplished the goal of diversifying their net worth, taking chips off the table, and insulating their lifestyle so that if the company ends up not succeeding or not being successful in the long term, they've at least pulled the $25 million out and they've protected themselves to an extent. Again, the 51% is still at risk, but they have protected themselves up to that $25 million number. Step 6 now talks about how the loan to the commercial lender is ultimately going to get repaid with pre-tax dollars. So as I said earlier, in the S-Corp scenario, in a 100% S-Corp scenario, the company can operate tax-free. But in a C-Corp scenario, if the company can't operate tax-free because it's a C corporation, there are ways to minimize the tax leakage at the corporate level while you have the ESOP in place. So this step here, step 6, shows that in any given year, the company would make a contribution or a dividend payment to the ESOP. And like any company that's making a contribution or dividend into a qualified plan, they are creating a tax deduction by doing so. Step 7 then shows the ESOP giving that same money right back to the company. So a company makes the contribution to the ESOP then turns around and gives the money right back to the company. Well, why did it do so? It did that because it's repaying the company for that $25 million loan that the company made to the ESOP in order to give the ESOP the funds to then purchase the stock from the selling shareholder. So now the ESOP's made that ESOP inside loan repayment, circular motion, then in step 8, giving the company the cash to repay the commercial lender. So now the company has repaid the commercial lender with pre-tax dollars because of that motion and because of that strategy that we just discussed. Step 9, as the debt is being repaid, what's taking place is the ESOP is now allocating shares from the ESOP suspense account into all of the employee accounts. The way that that works, because what we've continued to talk about are all the benefits to the company and to the selling shareholder, but we haven't really discussed what is in it for the employees. What's the benefit to the employees? And so the benefit to the employees is they're ultimately going to be the economic beneficiaries of the company. Think of a 401k plan, for example. In a 401k plan, all the employees that are eligible to participate in the 401k can contribute their own monies into their 401k plan. They can then diversify themselves by purchasing different mutual funds or exchange-traded funds that they want to purchase. And they ultimately build the nest egg or build a retirement fund for their families. Well, with an ESOP, the biggest drawback that we hear as professionals from business owners and CPAs and investment bankers and all the individuals that we're educating through this process, the biggest misconception or the biggest drawback we hear is, well, all this sounds great, but my employees don't have the money to purchase my stock. Well, as you can see, that is a misconception. The employees are never taking money out of their own pocket to purchase anything. It is a free retirement benefit that the employees are getting. The money's coming from the commercial lender. But the way that the employees are getting the stock is through their own personal ESOP accounts. So if you have 50 employees, each one of those 50 employees, so long as they're eligible, are going to have their own personal ESOP account. And every year, as that debt is being repaid, shares of stock from the ESOP suspense account are going to start getting allocated to each one of those 50 employees. And the way that the stock is getting allocated is a direct correlation to payroll. So if one employee makes $50,000 and another makes $100,000, to use round numbers, the person making $100,000 is going to get about double the stock of the individual that's making $50,000. And so your higher compensated individuals are going to get more stock. Your lower compensated individuals will get less, helping you incentivize hopefully your key management and your more tenure employees. And then every year there's an annual valuation that's done. So somebody comes in and values the company, and obviously that valuation is then passed on through to each one of the individual employees. They get a statement and they see what their ESOP shares are worth. So an employee that's there 2 years, 5 years, 10, 15 years, every year is accumulating more shares and accumulating a greater amount of value, which is ultimately allowing them and providing them the opportunity to support their family once they go into retirement. So that was a lot about the process and the creation of the ESOP and the flow of funds, but that, in my opinion, is an extremely important point as to understanding how an ESOP really works. Because there's a lot of misconceptions and there's a lot of confusion around where the money's coming from, the tax benefits, and how it ultimately goes from the sellers having an exit strategy or having an actual sale of a business to then the employees being the economic beneficiaries. So what I'd like to do is, because I have about 7 or so minutes, Bruce and I talked about leaving 15 minutes for questions. What I want to do is I want to skip down to one of the case studies, and we'll go over that. Let's go over the middle case study, Bruce. Family matters. Good time to be talking about family. I'm sure if anyone on the phone is much like my own family, I'm stuck at home, quarantined with my wife and my 11-month-old. And so we're spending a lot of quality time together, which has been great. But my wife deals with an 11-month-old during the day, and then she has to deal with me once I get off work. So I feel for her on that. So let's talk about this. And we're on slide 29, Bruce. So this was an example of a couple, husband and wife in their mid-50s, had 2 children, and had really started to talk about an exit strategy that would both benefit themselves, but not create an exit strategy that was ultimately going to have them have to give up the business. They weren't ready to do that. They weren't ready to transition the business to private equity or to a strategic or someone that was going to come in and really disrupt the legacy and the culture that they've created. On the same token, they needed to get some liquidity out of the business. They had very little to no assets outside, and they also needed to diversify themselves in the event that something happened to the company long term. So what we did is we ultimately educated them and their CPA around a partial ESOP. They sold 30% of the stock to the ESOP. They were in California. They avoided close to 37.1% in capital gains tax. They pulled that liquidity out. They diversified themselves, and they continue to run the company as a 70% shareholder today. Now, this was a few years ago, and we're already in conversations with them now about whether or not it makes sense to go ahead and sell 19% of the business, which would take them from a 30% shareholder to a 49%, or does it make sense to sell the entire 70% to the ESOP and go to 100% ESOP owned? There's pros and cons to both of those strategies, but it's really about the transition of what's going to take place in the next generation. Because the two children that they have are in the business, but the two children are not old enough yet to where the husband and wife are comfortable saying they have what it takes to run this company long term. So in my opinion, what I think is going to end up happening with this company, and what we see with a lot of family-owned companies, is they're ultimately going to sell 19% of the stock to the ESOP, so take another 19% of the equity value off the table. They'll continue to run the company as 51% shareholders. And then my instincts are one of the two children will be able to run this company long term. And what the mom and dad will do, since they've pulled 49% of the equity value out and they don't need any more to support their lifestyle, they'll then transfer the other 51% of the equity value to either both or one of the children. And from an estate planning perspective, it's a great way to get that capital or that net worth out of mom and dad's taxable estate, get it to the children, and then allow the children to run the company as 51% shareholders. And they can ultimately create their own legacy when they're ready to monetize the business, whether they want to sell it to an ESOP or whether they want to hold on to it or sell it outright. That's a decision that they can make at any point in time. So let me pause there. Bruce, we're about 2 minutes away from where we wanted to be before we took questions. Why don't we open it up and see if anyone has questions now before we continue?
Okay, we do have a couple of questions here. Here's a question. Can employees who own stock sell it to anyone outside the company?
I believe the question was, can employees who currently own stock sell it to anyone outside the company?
That's correct.
Is that right? Okay.
Yes.
So if I think the question is, if what you're asking is, if somebody within the company is a existing shareholder, can they sell that stock to somebody that's not in the company? Absolutely. That would be more like, or it would be more analogous to an outright sale. So you would identify somebody outside the business that you thought would be a good shareholder, and you could sell that stock to them. And if that person then owned a minority or controlling interest, they would obviously just be another owner within the company. But that would have to be, it would be similar to a management buyout, but instead of the managers purchasing the stock, it would just be an individual. And they would have to come up with their own capital. You'd have to structure some sort of seller financing in order to consummate that transaction.
Okay. The question is, how is the value determined for the stock?
Yeah, really good question. So in an ESOP transaction, you have a lot of professionals around the deal. So typically what we see is on the sell side, meaning representing the selling shareholder, so the individual that's selling the stock, you have typically an investment banker. You have a team like ours that focuses predominantly on the general consulting of a transaction, but also on the 1042 and helping the business owner ultimately avoid the capital gains tax in connection with the sale. You have attorneys and hopefully some sort of tax advisor. On the buy side of the transaction, you'll have a independent third-party trustee, and that trustee is acting as a fiduciary in the best interest of the employees. So they're hired for the purposes of negotiating the transaction value and the transaction specifics with the sell side team and presumably the owner and the investment banker. That trustee has its own advisors. That trustee has an advisor in a valuation firm, so somebody that's actually doing an independent third-party valuation for them, as well as their own legal counsel. So the direct answer is, in a transaction, you typically have two valuations that are done. You have a valuation done on the buy side and on the sell side by the investment bankers and by the valuation team on the trust side that are negotiating with one another. And then post-transaction, you typically have an annual valuation that's done every year, and that's how you can identify the value of the stock as an employee, so you know what your ultimate benefit is, and that's also done by an independent third-party valuation firm. One other point to make before we move on is ESOPs cannot pay more than fair market value. So when you talk about value and what level of value you get, what the industry standard is no more than fair market value. And I would say that that's extremely important when looking at an ESOP and understanding how does the valuation that I'm going to get in a strategic and private equity offer compare to the valuation that I'm going to get in an ESOP transaction.
All right, here's another question. How do employees typically fund the equity purchase?
So the employees never are taking money out of their pocket to actually purchase the stock. The money is coming directly from a commercial lender in this example. So the employees are the economic beneficiaries, but they're not taking on any financial risk. So what happens is the commercial lender lends the money to the company lends the money to the ESOP, and then the ESOP takes those proceeds to purchase the stock directly from the selling shareholder, and then through the corporate profits, the corporation then retires the outside loan to the commercial lender. But again, the employees are actually never taking money out of their pocket to purchase the equity. It's given to them based on their compensation levels.
Here's another question. Have you seen companies that have ESOPs sort of increase or decrease in value after the original owner takes their share out of the company?
That's a fantastic question, and there isn't really a right or wrong answer. I think I don't have the numbers in front of me, but the obvious point that I would make is we've obviously seen a tremendous amount of transactions that have taken place over our team's been doing this over 20 years. And we've done over 220 of these transactions. And I would say that what you want to focus on is not necessarily I wouldn't focus on the ESOP and how the ESOP profitability or the company's profitability is impacted by the ESOP post-transaction. I'd look at it more on the front end of a transaction and say, is this company the right fit for an ESOP? And I think all too often, ESOPs are put in place that should have never been put in place in the first place, for whatever reason. No management team, too much debt, not consistent cash flows, whatever the reason is. And so unfortunately, what happens in those examples is the ESOP's put in place, the company falters because it should have never been an ESOP in the first place. The ESOP then subsequently fails, or the company subsequently fails, and people want to point to the ESOP as the reason that it happened when it really should have never been an ESOP to begin with. So what I like to focus on is what makes the company or the employees or the owner, what makes them a good fit for an ESOP? And if they're a good fit for an ESOP, both because of the cash flow, the debt capacity, the management team, the fire in the belly of the business owner, that really, I think, is what drives profitability in a company post-ESOP transaction. And if you go to the nceo.org, if you Google the ESOP Association, you'll see plenty of studies that have been done that support higher productivity and higher profitability in ESOP-owned companies compared to non-ESOP-owned companies.
Here's a question. There has to be a minimum of 30 employees. Is that a rule of some sort?
So it's not a rule. It's more, or I should say, it's not a law. It's more of a rule of thumb. So typically, what we like to see is greater than 20 employees. Anywhere between 20 and 30 is a little bit in the gray, and then obviously anything greater than 30 we're comfortable with. And the reason is for 409P and 409A testing. Because this is a qualified plan, there has to be certain levels of diversification within the actual ESOP. So if you don't have enough employees and there's not enough diversification within the ESOP, you could potentially fail the 409A or 409P testing, and that would not be good from a compliance perspective. So 30 employees is not a law. It's more of a rule of thumb, but it's because of the 409A and 409P testing that needs to take place to make sure that an ESOP works and makes sense.
Okay, here's a question. What's the tax impact on employees as shares are posted to their ESOP accounts? It would seem to me that it would have to be considered compensation. Is that true?
It's not compensation. So what's happening is it's a contribution. It's a company contribution into the qualified retirement plan, and they are a participant within the qualified retirement plan. So they would have their own ESOP account. Their tax liability does not take place when they receive the shares. Their tax liability takes place when they want to take money out of the ESOP account. I would say it's analogous to taking money out of a 401k or any sort of qualified plan. So in 10 years, 15 years, 20 years, if they've accumulated a $500,000 balance in their ESOP account, and for whatever reason, they leave the company, and then the company gives them $500,000 of cash into their ESOP account, they then have the opportunity to roll that $500,000 out of their ESOP account into another qualified plan, into an IRA, for example. So now they have $500,000 sitting in an IRA. And at that point in time, Bruce, they then have to make the financial decision about whether or not they want to keep it in the IRA and continue the tax-deferred growth, or if it makes sense to take the money out for whatever reason, pay the taxes or pay the penalties that may come with it if they don't wait until their full retirement age. But the taxation on the account is going to be the same as the taxation on a 401k plan.
Okay, we've got time for a couple more questions here. Here's another one. Are there certain commercial banks that are dedicated to ESOP financing, or is it usually the company's local bank?
Yeah, that's a great question because, as I said earlier, three things that are most important in these transactions, and I'm not just talking ESOP, I'm talking about M&A in general, is the valuation and cash at close were two of them. Cash at close of the transaction is completely contingent on the company's ability to take a loan from a commercial lender. And a lot of times, to your point, that commercial lender may be the incumbent bank. But a lot of times, it's not the incumbent bank because the incumbent bank may not have the level of ESOP experience or sophistication, or just they don't understand it to the point where they can get comfortable lending money to an ESOP-owned company. Because if you think about the balance sheet of a company post-transaction, it's almost entirely flipped upside down. Because if you look at my example from earlier, let's just say you have that $50 million company and the selling shareholder chooses to sell 100% of the value of the company in connection with this transaction. Well, the company took on $25 million of debt from the commercial lender. And then when the seller sold, the seller got that $25 million of cash. They also got a $25 million IOU from the company. So that's another source of debt from the company. Commercial lender's the senior lender. selling shareholders a junior lender. Why do I explain that? Because now you have $50 million of debt on the balance sheet of the company, whereas the enterprise value one day pre-closing was $50 million. So the company's balance sheet is almost entirely flipped upside down. So that's why the importance of working with a commercial lender that understands this business is imperative. And that's all part of the process. And a lot of larger commercial lenders have dedicated ESOP teams that understand the nuances and the complexities, and they're in one centralized location. And we have relationships with these lenders all around the country that our clients ultimately lean on to get the proper funding to make sure that the transaction is funded correctly.
Here's another question. Have you seen ESOPs become more or less popular given the change in the tax law from several years ago?
We've seen ESOPs become more popular since the tax law changes from 2012 to 2013. The tax law change essentially went from capital gains tax rates going up from 15 to 20% at the maximum, as well as the inclusion of the 3.8% Medicare surtax. So capital gains tax in a worst case scenario went up by almost 8.8%. So a seller in 2012 may have only paid 20% all in. Same seller in 2013 would have paid 28.8%, pretty significant difference. So when you're talking about at the individual level, we've certainly had more and more shareholders, selling shareholders, want to discuss an ESOP purely for the economic and tax benefits to them personally than we did pre-2013. I would also say in the environment that we're in now, just to discuss what obviously is going on in the general M&A markets, COVID-19 has obviously slowed M&A down tremendously. But what we're seeing a lot of entrepreneurs and business owners do is pivot away from outright sales or pivot away from 100% ESOP transaction and look at a partial transaction. Because if their business is down at all, they don't like the idea, and I don't blame them, they don't like the idea of selling at a discount today, or selling, I should say, 100% of their business at a discount today. So what they're exploring is, does it make sense to potentially just sell 30%, knowing they're taking a small discount because of COVID-19, but they're getting some diversification and they're getting some liquidity that they thought emotionally and psychologically they were going to receive pre-COVID-19, and then they continue to run the company as a 70% shareholder. At the same time, they're rewarding loyal and key employees, because now those key employees are now the general population of the employees are economic beneficiaries of that 30%. So through this difficult time, it's a scenario where it's a win-win. Business owners able to take some liquidity off the table, able to diversify themselves, and also reward employees for the hard work through a very challenging time economically.
Okay, we've got a couple of minutes left here, so let me ask sort of one or two last questions. Won't the amount paid by a strategic buyer be higher than an ESOP transaction, which must be at fair market value?
I would say that is true some of the time, but not all the time. If you have a true strategic buyer, I'll point at, what I'll do? Let's talk about different sectors for a second. If you're talking about software or technology companies, absolutely. If there's a true strategic buyer out there willing to pay a significant premium, it's going to be extremely difficult for the ESOP to compete. It just won't be able to. It's even after the after-tax benefit of the ESOP. But if there's not that true strategic premium or that true strategic buyer out there, depending on the state in which the selling shareholder lives, because of the tax benefit, obviously, of selling stock to the ESOP, we see the ESOP be able to compete with a strategic buyer a lot of the time. But again, if you have a true strategic buyer, paying a real strategic premium, it's going to be really difficult for the ESOP to compete. So I would agree with that. And in terms of sectors that we do work in or that we see a lot of ESOPs take place in, construction is pretty huge. Manufacturing, architectural, healthcare has picked up significantly. There's a lot of breweries that have explored ESOPs. So there's a lot of different industries and sectors that explore ESOPs as a general exit strategy. I would say, again, software, technology, basically companies that trade for significant premiums in the open market, those are going to be the ones that usually don't explore the ESOP as a possible exit strategy.
Okay, we've reached sort of the magic 1 hour mark here. I would like to shut down the webinar. And Nick, I appreciate all of the good work you've done here. I think got some good questions, and people will obviously be able to hear the video later on. So unless there's any more questions here, I'm going to, oh, here's one last question. Okay. Are all commercial lenders familiar with lending for ESOPs, or are there specific lenders for it?
Not every commercial lender is going to be familiar with ESOPs. There are certain commercial lenders within the country that dominate the space, that do a prominent amount of the lending, but it's certainly not every single commercial bank. A lot of it comes down to the terms that the lender is willing to give you. Obviously, covenants are extremely important, interest rates, repayments, and most importantly, or maybe not most importantly, but definitely up there, is personal guarantees, right? Most of these transactions that we're working on do not have personal guarantees. And the reason that's extremely relevant is if I just walked you through that flow of funds and there was a personal guarantee tied to that $25 million loan to the commercial lender, well, then you're giving up 49% of the equity value of the company, giving up 49% of the upside, and you're not taking any risk off the table because you're still on the hook for the $25 million loan to the commercial lender. So it's extremely important when exploring this to consider, does this loan have a personal guarantee or not? I would advocate, if I was working with a client, that they not do a transaction with a personal guarantee if they have any sort of flexibility around it, because that's really truly how you diversify yourself, is by getting that equity out through the commercial lender without the personal guarantee.
Okay, with that, we are out of questions, so I think it's time to close the presentation. Nick, thank you very much, and hopefully we will chat some more about this topic next time. So with that, I am going to close the webinar. Thank you. Thank you to everyone who's attended.